This is InvestTalk. Independent thinking, shared success.
Hi, I'm calling you about XOVR. I just heard about this fund, and I would like your opinion on it. I'll be listening. Thank you.
So let's take a look at ticker XOVR. That is the ER shares, all one word, private public crossover ETF. Now, what this does is it looks like it is a curated selection of U.S. large cap growth stocks focusing on the top 30 most entrepreneurial companies based on a proprietary metric. And it actually invests in both public and private names. So that's interesting. You're not just getting exposure to public equities, you're also getting exposure to some private companies as well. I think SpaceX might be on here, a little exposure to SpaceX in this name. But the top names you'll recognize: Oracle, Meta, NVIDIA, Alphabet being the largest, Salesforce, Tesla. It's got a lot of exposure to the US dollar, but overall 98% of it is in equities. And this is not a fund I have seen before this question came in, I will be honest. And so you're getting my initial reactions. And first and foremost, a big reaction I have is it's expensive, 75 basis points. It's small, 231 million under management. But more than anything, it's changed, right? So you're looking at this historical performance here. And according to this fund insight, this historical performance should be meaningless to you because prior to August 29th, 2024, the fund was actively managed and followed a completely different strategy. Then recently, after August of 2024, that's when they started adding their private exposure. Their active management is on the private side. The public side is essentially just tracking an index created by the London Stock Exchange. So if you're looking at historical performance, absolutely meaningless now. Performance should diverge from what they had before because the strategy is completely different. Another thing that's striking to me is, well, it follows its benchmark is the MSCI USA IMI. For those of you who don't know what that is, that the USA investable market index. It's everything, top to bottom. And from what I can see, this fund is not trying to deliver that asset class. So is it an appropriate benchmark? Also, probably no. So we can't really trust these past returns because it's a different strategy. This benchmark isn't even a good proxy for what they're trying to deliver. It's invested in private companies, which tend to have or be less liquid, which means that if it does have liquidity runs, if you need your money, they're probably going to end up redeeming from the public side. So you're going to hold on to those private illiquid names, sell off those public names. And they're doing a lot of these things through proprietary metrics that they don't share. So I think this kind of breaks the cardinal rule of knowing what you own. Now, if you want to have a small allocation to this, understanding that it's 75 basis points in management fees, you want to have a small allocation because you know what? You want to get a little bit of exposure to private names. I think I'm fine with that, but I wouldn't go crazy here because you really don't fully understand not only what the actual market value of those private investments are, because that's how private funds work, private companies work, but you don't really know the proprietary metrics here. So like 2%, 3%, 4% allocation maybe, just to get those private names as a sort of alternative investment allocation, I'm fine with. But having a substantial allocation here to something that the historical performance means nothing, it's a completely different fund, and you can't get much information on it, I would pass in that respect. Thanks for the call. Looks like we got a live call. This one from Eric from San Francisco, looking at EMN. Do you own it or are you looking to buy it?
First of all, good luck on your Eagles. I believe you're an Eagles fan. If I remember
I am an Eagles fan. Thank you, Eric. Are you a Rams fan? No, you must be a 49ers fan.
No, I'm a 49ers fan, yes. Rooting for the Commanders, though, this time around. Question about Eastman Chemicals. Actually, it's a little more broad. I was just asking about the chemical industry as a whole. I do own Eastman. I'm up a good amount, but I was wondering if you think it may be time to consolidate. Another stock I own is Celanese, CE. It seems to be going in the opposite direction. I'm just wondering, what your thoughts are on the chemical or basic materials sector and what you think it'll do in 2025. Thank you.
Yeah, that's a great question. And thank you for the well wishes for my Eagles. I always appreciate that. Well, interestingly enough, Eastman Chemical is a name that I do like because we own it in one of our investment strategies. It is up 2% year to date, down 14% in the past 3 months. We have been buying it up over the past 3 months because generally speaking, what you saw over the past 2 years was a surge in tech, a surge in the AI secular growth theme, but really a lot of industrial and basic material names left behind because global demand has been lower. And so how we have transitioned a lot of our strategies is away from some of those growth AI names and towards kind of the backbone of industrial demand, these basic materials and industrial names. And certainly in one of our strategies, Eastman is one of those. Now, interesting to note, there is, I think the biggest environmental concern, which we saw over the past year, was around their recycling abilities, which kind of put a negative reputational risk on this company. But that's not something we'll probably see going forward. And so for Eastman, for some of these names that have started to move in the direction that we like, we certainly love their turnaround in terms of their growth from 2023 to 2024. So, anytime you see a materials name, a chemicals name, any name within the materials and energy space, we say this all the time, right? It's based upon the demand and the price dynamics of the underlying commodity. So naturally, you've seen a fluctuation coming out of 2021, 2022's highs, but that started to turn around a little bit. Additionally, cash flow has been improving. And margins, even though you really haven't hit that peak that you saw in revenue in 2022, margins have been expanding, right? EBIT margin grew from 14%, projected to be 14.2 this year, and started to head in the right direction back in 2023. So overall in Eastman, I think if you're up a lot, it's okay to trim. No one ever went broke taking any profits, but it's still a solid name that has a great balance sheet, only $5 billion in debt, and that's pretty low interest debt that's pushed out because their interest coverage ratio is 6.2, meaning that they can cover their interest expense with their earnings before interest and taxes 6 times over. So overall, I see a company in an industry that is probably going to stand to benefit over the next 6 months to a year as demand picks up globally. Thanks for the call.
Hey, Justin or Luke, this is Randy from Tampa, Florida. Hope you're doing well, and thank you for all you do. Been a long-time listener and now watch on YouTube a lot. And I have a stock I want to see your opinion on. It is Zscaler, ticker symbol ZS. I really like the opportunity in that space and looking to add a position into that, but want to get your thoughts on this. Look forward to hearing my question on your show. Thank you.
So Zscaler, ticker ZS, is a cloud security services company. And that's a pretty broad, category, certainly a competitive category. But you should think of this essentially as a centralized gate that is inspecting all the traffic that runs through it amongst many devices for a given server, be it employees of a company or customers of a business. And so it provides this secure access, right? Keeping bad actors out. And so naturally, as the world is moving closer and closer to the cloud, and you have millions and millions and millions of users connecting to these businesses on the internet, security is incredibly important. Now, taking a look at the fundamentals of this company, it's a $28 billion market cap company. It's got about $1.2 billion in debt, but it doesn't make any money. It has not made money in the past 6 years. It's moving close and closer to positivity. Interestingly enough, it hit its most negative during the pandemic, where you'd expect that cloud security would have been top of mind. But either way, it is projected to make money for the first time this year. Now, taking a look at their fiscal quarters, because their year end is July, in October of last year, it didn't make any money. So it started to project to make money this quarter, so January. And then April and July quarters will make up for the fact that it was negative in January. Cash flow is, again, headed in the right direction, and their margins are becoming less and less negative, which is fine, right? It's generally, we don't like companies that don't make money, but I'm not just going to kick it out because it hasn't turned positive yet if it's projected to turn positive. Now, with all of that in mind, If they aren't making any money, and they don't have that much debt, only $1 billion in debt, how are they running the business? And the answer is they're issuing a bunch of shares. Since 2020, they've gone from 130 million shares outstanding to 155 million shares outstanding. Now, interestingly enough, right, they had a little bit of a pop at some point last year off of decent earnings, but the guidance was bad, right? In the middle of the year, the guidance wasn't great, right? Billing guidance wasn't great. And so year to date, even though they're up 4%, in the past year, they're down 16%. And we all know how the market did last year. They underperformed the S&P 500 by 41%. And so they aren't making money. They're growing, though growth looks like has slowed a little bit from the 48% annualized basis that it has been over the past 6 years. But they're also really expensive. 20 times book value, 33 times cash flow, 12 times sales. Honestly, on the back of the less than stellar guidance at their most recent earnings report, and the fact that they're still incredibly expensive in a quickly evolving competitive landscape, I think I'm going to have to pass on this name with growth slowing. Even though they're starting to make money this year, it looks like they haven't yet. They haven't announced January earnings yet. They'll do that February 27th. These are all just projections. I think for Zscaler, that's ticker ZS, or is it Zscaler? Because it is one word. Gonna have to pass. Thanks for the call. Well, let's play two in a row. This one on how to analyze ETFs.
Hey, Luke and Justin. This is Rob calling from Las Vegas. I was wondering if you could shed some light on how you analyze ETFs. For example, I'm looking at two utilities ETFs, the Invesco S&P 500 Equal Weight Utilities ETF, RSPU, and the First Trust Utilities ETF, FXU. And I'm having a tough time on how to interpret and analyze ETFs. Wanted to see if you could provide some insight on the metrics that you guys use, not only for these two, but for maybe all ETFs. If you wouldn't mind providing your analysis, I'd love to hear that. I'd be listening on the next podcast. Thank you.
Okie doke. Well, let's dive into this because it can be a complicated question. And so we'll talk about how we would broadly look at it and kind of how that tells us in which direction we'd go here. And so when you're looking at ETFs, the first question is, what is your goal? What asset class are you looking for? And how does it deliver that asset class? Similar to a company, you also need to know what you own. Right? How is it actually delivering it? Is it transparent? And then lastly, what am I paying for it? I'd break it up into those three categories. So clearly what you're looking for is utilities exposure. So the first one is the RSPU. It's the Invesco S&P 500 Equal Weight Utilities ETF. So we're checking the box there that it is supposed to deliver utilities and their exposure looks like it does, right? Energy utilities being the primary utility that they are exposed to. Now, the second one, also utilities ETF, First Trust Utilities AlphaDex Fund, is again exposed primarily to these energy utilities. Now, the next thing is understanding what generally tends to outperform over time. Small caps, mid caps, large cap, small cap premium is what it's called. It tends to be monotonic. Funds, indices that tilt towards smaller names, more profitable names, those value names, tend to do better. So what we are looking for with ETFs is, are you attacking that asset class in a way that is attacking the drivers of expected return over time, right? So we'd look at their market cap exposure. Looks like FXU, pretty underweight large cap relative to the benchmark. And you're going to see the same thing with the other fund, RSPU, because it's an equal weight index. What does equal weight do? Well, a lot of indices, S&P 500, the things that people are tracking, the Russell 3000, those are market cap weighted, meaning the size of the company is going to be proportionate to the size of the exposure in the fund. This is equal weight, meaning every name has the same weight. Now, inherently, what that's going to do is weight towards small caps. And you see that here, although not as much in a pronounced way, right? You see large caps is heavily exposed here. Okay, so we know what it's doing. We know what it's attacking. Well, how's it doing it? Equal weight, pretty simple. This is just going to track a equal weighted index of large cap utility companies. Very straightforward. Well, the other one, FXU, it's quant-based model that picks stocks that are predicted to outperform the broader market. Seems like a black box to me. So on the box of, do I understand how this is doing this? FXU is a lot more complicated, more of a black box than an equal weight index. It's also more expensive, 64 basis points versus about 40 basis points. And so if I had to choose between these, I would always choose the one that I understand. RSPU, Invesco S&P 500 equal weight utilities. And so when you're looking at these ETFs, how much do they cost? Is it actually delivering the asset class that I'm trying to get? And do I even understand how it's doing it? Do they even make it transparent? Thanks for the call. Now we got news, and honestly, it seems like another act in an ongoing play. And that play is titled the U.S. debt ceiling. Now, according to Treasury Secretary Janet Yellen, on Tuesday, the U.S. government will hit its $36.1 trillion debt limit. And what that does is it forces the Treasury Department to begin extraordinary measures to avoid default. And so let's take a step back. What is the debt ceiling? The debt ceiling is not allowing us, right? It's not talking about the deficit. The debt ceiling is the accumulation of all debt by the US government, meaning that it is money that is already spent. And functionally, when you hit the debt limit, it doesn't allow you to continue to borrow to pay for appropriated funds or pay the interest on our debt or anything, right? And so the problem is when you hit that limit, it stops your ability to do anything else. And so when we hit that limit, the Treasury Department takes these measures to drain the Treasury General account, waiting for Congress to act. Now, taking a look at a higher level, the Congressional Budget Office projects that the U.S. debt will reach 99.9% of GDP this year and surpass its post-World War II high by 2029. Annual deficits are expected to remain above 5% of GDP for the next decade, with interest payments exceeding $1 trillion by 2026. Now, a lot of people like to focus on this. They like to focus on debt as a percentage of GDP or the deficit as a percentage of GDP. And that's the wrong way to look at it. It's a simple way to look at it, but it's the wrong way to look at it. We live in a world where modern economics understands the power of leverage and the power of debt to spur growth. The goal here is to borrow money to increase the capacity of the economy to expand and to grow. And so as long as this is actually a paper by Larry Summers and someone else who I forgot over at Harvard, but essentially rather than looking at debt to GDP or deficit to GDP, what you should be looking at is the real debt servicing cost. So in real terms, adjusted for inflation, how much does it cost to service your debt relative to your growth rate? Meaning you can take on more debt if the economy is growing faster, if it makes the economy grow faster, because you inflate away the debt, the economy grows, it becomes worth less in the future. That's how you should be looking at it. It's more complex, but it's the right way. Now, by 2027, these payments will be the larger share of the economy than at any point since 1940. And what added wrinkles to this is that President-elect Donald Trump and Republicans, who control Congress and will soon control the White House, are looking to extend the 2017 tax cuts and possibly add even new tax reductions, which is only one part of the piece because they still remain divided on spending cuts, right? Most of the government spending isn't employees. You know, people have been saying, we'll just cut the government employees by 75% on day one. That doesn't do anything. That is not how the government spends money. The government spends money on things that are non-discretionary, right? Medicare. Spends things on defense, right? And so firing employees is not going to solve our issue here. You actually have to cut spending. And President Trump has thus far ruled out reductions to Social Security and Medicare. And so what has the market done? Well, the market has responded with rising treasury yields, the 10-year up to 4.6%. And what's the bad part about that? Well, if there's a finite amount of money in the world, and certainly you can print money, but I mean capital. There's a finite amount of capital in the world that is available for lending. The more and more governments borrow, the less and less we can borrow, the less and less businesses can borrow at those cheap costs. And so as government debt rises, this is your real problem, the cost for businesses and consumers to fund things goes up as well. And so this is going to be the first most important battle of the next administration, right? It's going to be raising the debt ceiling. It's going to be okaying the fact that we already spent this money and we need to keep paying for it. And so that'll be what I'm watching in the coming weeks. How quickly will this be resolved? It always has in the past, but certainly if it doesn't, that means that economic disaster is looming. Thanks. Now on Fridays, we generally make time to fit in a quick rundown of key benchmark numbers, so let me hit you with that list right now. The 2-year Treasury yield was at 4.266% today. For perspective, last week it was at 4.369. 25 weeks back it was at 3.882, and 63 weeks ago it was at 5.05. The 10-year yield, as I mentioned, was over 4.6. It was at 4.609% today. For perspective, last week it was at 4.77. 21 weeks ago it was at 3.921, and 63 weeks back it was at 4.63. Gold was priced at $2,708 per ounce today. Last week it was at $2,687. 63 weeks ago it was at $1,935, and 151 weeks ago it was at $1,806. Silver today was at $30.33 per ounce. Last week it was at $30.45. 49 weeks ago it was at $22.80, and 144 weeks back it was at $23.94. Oil was selling for $78.20 per barrel today. That's an increase of $1.67 compared with last week. 17 weeks back, it was $67.79. 59 weeks ago, it was $74.30. And 159 weeks ago, it was $66.62. National average for a gallon of regular gasoline is $3.11, a 5-cent increase compared with its price last week. 85 weeks ago, it was $3.56. And 133 weeks ago, it was $4.25. In California, it was averaging $4.43 per gallon, a 5-cent increase over last week. 63 weeks ago, that was $5.32, and 139 weeks back, that was $5.87. For comparison, in New Mexico, gas was averaging $2.88 per gallon today. That is $1.55 less per gallon than gas in California. Now, the last thing I wanted to mention, we're going to skip over the story on the importance of order of operations and policy, because I think our goal here is not only to educate you, but also to do what we can to help you protect yourselves. And so I saw a story about a hidden conflict of interest that may be influencing the way your financial advisor manages your money. Behind the scenes, some of the biggest custodians, companies like Fidelity and Schwab, are pressuring advisors to generate more revenue for them, often at the expense of clients. And so I read about the case of Mark Armbruster, a financial advisor in New York managing nearly $900 million in assets. Late last year, he says that Fidelity, which serves as his firm's custodian, told him he needed to generate an additional $90,000 in annual revenue. And so they laid out options to achieve that, right? Including shifting client funds into Fidelity-run investment products with lower yields or higher fees. One suggested move was transferring $3 million into Fidelity's F-Cash fund, yielding just 2.19%, or reallocating $80 million from low-cost index funds to a more expensive, actively managed Fidelity bond fund. And so why would they do that? Well, because those changes would boost Fidelity's profits. But they would also potentially reduce the returns for Armbruster's clients. And this practice is becoming more common. Michael Keitz, an industry analyst, says that revenue conversations between custodians and advisors are happening with increasing regularity and frequency. The reason why is because trading fees are declining. Custodians are pushing advisors to make choices that benefit the custodial firm, even if they're not best for investors. Fidelity, for what it's worth, defends its approach, saying it presented multiple options and that final decisions are up to the advisor, but the asset shifts themselves are pressure from custodians to compromise their fiduciary duty. Fiduciary advisors, like we are, have an obligation to act in the best interest of clients. And so what did he do? Well, he refused to comply, something we would do as well. We would refuse to comply. Our job at KPP is to act in the best interest of our clients, no matter what the custodian says in terms of generating more fees or profits for themselves. It is, as he put it perfectly, disturbing and egregious. Especially because there's a more transparent alternative, right? Explicit custodial fees, which Fidelity also offers Sometimes they charge money per account per year instead of influencing investment decisions or trying to influence investment decisions. But from a business perspective, for some advisors, they worry that if they pass that fee along, then their clients might go elsewhere. $375 is a lot of money to a lot of people. And so they don't want to lose that business. So what's the takeaway for you? Other than the fact that generally we go through this life hoping that the people that we put our faith in, the people we put our trust in, will act in our best interest. And there are some of us that spend their non-normal job working hours, such as myself, decrying those who take advantage of their clients who have put the sacred trust in them to act in their best interest. But there are some people out there who see something like this and they say, yeah, sure, no problem. I'll put it in this fund. I want to maintain this relationship with this custodian. And so what should you do to look out for yourself? Well, the first thing you can do is ask your advisor whether their recommendations are influenced by custodians' financial incentives. We pride ourselves in being transparent with our clients. We encourage them to look at the trades that we're making, to monitor their portfolios, to take an active role in their financial investments. And you should be doing that as well. If you see something, say something. Why are you doing this trade? Why am I in this fund that is expensive? This does not make sense based upon what I thought my financial goals are. Always be your own advocate. Demand full transparency because your money should be working for you, not for anybody else. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family members about our free podcast downloads. You can get yours at iTunes, Google Play, and Spotify. And while you're over there, please be sure to leave us a rate and review. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. We can also help you build a full financial profile that will tell you how good you are and how well you've been saving for your retirement. It all starts at investtalk.com. Just click the portfolio review button. And while you're with us, we can also help you optimize your 401k. Once again, Monday is a federal holiday and the market will be closed. If you miss us, you can listen to the Best of InvestTalk episode we will be posting online. Independent thinking, shared success. This is InvestTalk. Enjoy the holiday week.